Hello, everybody. It is December 3rd, 2025. Wow, the year has flown. I have put together my annual outlook. It's a little bit early and it's a little subdued because I'm going to break this up into many pieces over the next month. But this is the important part. In 2026, sorry to tell you this, but I expect a financial crisis to start. I have made three gigantic predictions like this in my career. In 1999, after watching Jimmy Rogers at the end of 1998 say we were in a bubble, took me a year to figure it out. But I started selling all of my stocks at the end of 1999, except for a handful of small caps and a couple oil stocks, actually. Turns out we had a crash, and it lasted 2.5 years, almost 3 years. Once again, in 2007, I was buying dinners at Italian restaurants and steakhouses, telling people there is going to be a crash. I had more people fire me than hire me. There was a crash. You can go back on my Twitter feed and some of the articles I've showed the clip. In January, the very end of January 2020, I saw the first article about COVID. It was in CNN, I believe, and I started doing some checking. And by the next day, because I stayed up late that night, I was like, this doesn't sound right. I realized, and I kind of knew this because I have a good friend who's Chinese, and they were telling me about all the travel during Chinese New Year just a couple days earlier, so it wasn't fresh in my mind. I knew that COVID was going to cause a crash. It got more out of hand than I thought, and then the bailouts were bigger than I thought, and then they had bigger impact than I thought. But I said weeks before anybody else in two webinars and two articles, which you can find the webinars on the YouTube channel, Sell Almost Everything. I don't say sell almost everything very often. I don't. Because it's very rare that you don't want to be mostly long. You want to be mostly long stocks most of the time. However, we know that the presidential cycle generally creates a downtick in the second year of a presidency. That is not uncommon. Sometimes there's a major correction in the last year of a second term president. When we take a look at President Trump, this is the second year of this term, and it's kind of a first term because he wasn't in power the last 4 years. But it's also kind of a second term because a lot of the policies that he put in place in his first term, President Biden didn't reverse, or even if there were laws passed, didn't really act on them. And now I think we are lining up very possibly for a double dip recession. The last time this happened was the early 80s, and it was stagflationary. This is just the 30,000 foot view, and I'm going to go through this a little bit more in detail. But I think a lot of things are lining up that, if I'm right, probably lead to a major stock market correction. Most of the lofty valuations that need to be taken out are in the large caps. There's also some mid caps that are frothy, but for the most part, it's about 20 or 30 stocks in the S&P 500, maybe 20 or 30 stocks in the mid-cap 400, and a handful of small caps. The big risk is in the indexes. Why the indexes? Because they are market cap driven. So the S&P 500 and the NASDAQ 100 are market cap driven. The top 10 stocks and top 20 stocks in those indexes drive the index because they account for 60-70% of all the value. So now that we have, seven or is it $8 trillion companies, if they drop 20 or 30%, the index will drop 20 or 30%. What if they drop more than 20 or 30%? Then we have some bad news. Now, I think my base case remains a 20 to 30% bear market. However, the risk for the stock market to get cut in half, or even 60 or 70% lower, and by stock market, I mean the S&P 500, is not something that we can overlook right now. Fourth time in my career that I'm saying this. The only reason it didn't happen during COVID is $16 trillion of bailouts, or 17 trillion, whatever the heck it was. And that was just us. So right now we have major credit problems, not only in commercial real estate, but most credit measures outside of the top 10% of the population are in really bad shape. We've talked about people giving up their cars rather than letting their credit cards go bad. People are more tied to their credit cards now than they are to their cars. And that's probably because with a credit card, you can get an Uber. So as credit tightens, and I'm going to show you why it's going to tighten, the risk of a credit crunch increase quickly and steeply. The credit crisis here isn't some small thing. It isn't just a little bit more on top like it has been for 30 years. What we have now done is compact the vast majority of U.S. Treasury debt into the next 3 years. We are about $4 to $5 trillion per year short of cash for refinancing the debt that is coming due and financing all the tax breaks that mainly are going to the top 1 or 2% of the people. I know it feels good to be a 10% or 20% and save a few $100, but the vast majority of the money are going to people making middle 6 figures or 7 figures or more and are making a lot of their money in capital gains. So I understand that everybody likes their schnibbles, but we know, very quantifiable, very provable, very factual, we know that about 80% of all the tax breaks have gone to the richest 1 to 2% of the people. I've gotten some of that. I've talked about I get around 20 grand a year that I didn't used to get. I'm spending it on travel. I guess it's kind of good for the economy, but those types of tax breaks don't really go into hiring people. And even the people who get $1 million and $2 million and $3 million tax breaks, it's very rare that they turn around and put that into wages or CapEx. CapEx, you borrow. Why? Because if the company goes bad or the project goes bad, you declare bankruptcy. It doesn't hurt you personally. Everything is sheltered by structures to keep the super wealthy from being liable for the decisions they make. And you can argue with me about that. You can say that I'm a lib, whatever you want to say. I follow the money. I call bullshit where there should be bullshit called as best I can. And I grew up around a bunch of table thumping old men who taught me what bullshit was. And I've gotten pretty good at it. I will tell you right now that unless all the laws of the economic universe have changed, and maybe they have, that we are in trouble. When I say sell almost everything, which I will probably say next month, I'm not saying it right now, but I'm saying it next month, you know the game plan. The game plan is scale out of large cap and any overvalued stocks through the third Friday in January. Why the third Friday in January? Option expiration. And it's a big one. January is the biggest one of the year. We know that there's a lot of credit problems. So when you read this article, which will be up on Fundamental Trends as soon as this call is done, for those of you who are around 2007 and you did not get out of the way, or maybe you did, if you got out of the way, ask why, how, and put that thought process into effect right now. If you didn't get out of the way and you wish somebody had said, hey, pay attention, that's what I'm trying to do. The one variable here, and I want to cover this immediately on the front, and I'll talk about it again later. The variable is timing. We don't know exactly when Treasury is going to run into a problem. We don't know exactly when there's going to be a regional bank cockroach that gets in big trouble from their commercial real estate loans that are underwater and they just can't stand and pretend anymore. We don't know how much the Treasury can do without the Federal Reserve printing money. And one thing to really keep in mind is that all the people in office right now in the administration have just ripped to shreds Jerome Powell for having printed too much money. They all say they don't want to print money. I think they will stick to their guns until they have no other choice. Maybe I'm wrong. Maybe Kevin Hassett, I think that's who the next Fed chair is going to be. But he buys into the hard money stuff, weirdly, while he buys crypto. I think that a scenario that you should entertain is that we do not see rapid bailouts of magnitude until things get very painful. People who throw out the idea of a gold standard, I kind of laugh at them. It's one of the dumber ideas in the history of the world, but I understand that it gets asked. The simple reality is that going back to a gold standard would absolutely cause a depression. Purchasing power would be so destroyed and so skewed to China and the United States that the rest of the world would suffer. So the rest of the world certainly doesn't want to go that way. And the United States, because ultimately we'd still have the best credit in the world, even though we're going to take it in the chin for a while, Why would we want the gold standard? Because ultimately we are going to print our way out of this, and then we're going to export inflation, and it's going to be worse for other places than it is here. And during that time frame, I will tell you, when they print money, absolute easiest time to steal it, right? Hard to account for. If you take a look at some of the documentaries about the COVID money, about the loans, about the tax breaks, you will see billions of dollars that magically disappeared. So when money is printed, whether the Treasury does it through one mechanism and they actually sends it to the people they want stealing it, or they do it with the Fed and people have to be creative in how they steal, there will be theft. There'll be a few percent. The big loss will be for all the people who are not asset owners of substance. So 50, 60% of the population really gets hit. Another 30 or so percent of the population, they stop getting ahead. The top 10% of the population, which is supporting the entire economy right now, the top 10% of the population, which is mainly you, people watching this, are supporting the entire economy. You tell me, has it gotten just a little bit harder for you? I told you the story about I wanted a steak a while back, and the ribeye that I wanted was $35 a pound. I was like, it would be cheaper to go out and have somebody do it for me than cook it at home. So I think that it is very important to understand that quantitative easing is coming. All roads lead to quantitative easing. And if I'm wrong about that, there's a depression. The odds of QE before a crisis are almost zero because, as I said, they say they don't believe in it. I think they're going to be forced to believe in it. And I think that they will be buying assets dirt cheap with both hands right before the money printer turns on. Think that through. Understand what I just said. All right, so a credit crisis likely to begin in 2026. Emphasis on the word begins. I think it probably ends about 3 or 4 years from now, and I will show you why. Last month, I talked about the megaphone pattern that was overlaid onto the very high valuations and a slowing economy. The only part of the economy that's growing right now of any substance, anything above 1%, doesn't exist other than AI and AI-related things. The rest of the economy is growing at 1% or less. I think there's 1 or 2 parts that are growing at like 1.5%. So there's very low growth. If it's not tied to AI, either directly or indirectly, there's a problem. Energy in the last week or two just started to tick back up because we know that flattening oil supply means flattening natural gas supply into, even though oil demand is flat, natural gas demand is rising. So natural gas is one of those places where there's some opportunities. And you have to find investment vehicles that aren't priced expensively, like some natural gas investments are. The hidden place to get natural gas investments are oil companies that have a ton of natural gas, especially natural gas that never got to market before, but will next year because there's new pipelines to the Western Permian Basin. We've talked about those companies. Now, going into 2026, I'm very concerned about the debt wall that's coming. We are about $15 trillion short over the next 3 years on what we need to refinance the debt that's coming and the new debt that's being created. Anybody who believes that tariffs are of any substance to the budget is refusing to do the math. The tax cuts already in place are about 5 times higher than the amount that we're getting from the tariffs. We are not getting trillions of dollars from the tariffs. That is just a flat out lie. That's not a mistake by a senile old man. That is a deliberate lie. So if he's telling deliberate lies, the president's telling deliberate lies about the tariff revenue, you really should ask why. You should ask why. Why would he lie about that? It's not innocent. So while my base case is still the 20 to 30% bear market, there is a pretty high potential, higher than normal. I'd say around 20%, 25%, 1 in 4, 1 on 5, of a 50 to 70% large cap wipeout. When you take a look at the number of stocks in the middle of the market, which is about 400 of them, and then you look at the stocks that are overvalued to very overvalued, which is, what's left for the most part. There's 20 or 30 stocks that are maybe undervalued. You start to go, oh, look at those charts. And I'll show you a couple. It's a long way down if the first level of support is breached. if the first big level of support is hurt, I don't mean all the little levels of support. When we get to that 2022 floor, if we break through that, we're going back down to 2020. That's a long way down. So let's talk about the debt wall so that you understand it. As of December 2025, right now, there is about $9 trillion of marketable debt set to mature in 2026 alone. Next year, we have to refinance that debt on top of a $2 trillion deficit. We are way short when you take a look at the tax revenues and even with the very most optimistic view of what tariffs could be. And remember, the reason why we don't have inflation from the tariffs, according to them, is that they don't cause inflation. The reality is that they do cause inflation, but it's delayed after a slowdown that has to be bailed out. And that's what we're setting up for. Growth in all parts of the economy, other than AI related for the most part, have slowed down by half. And that's why we're not getting inflation. Also, we have seen unemployment tick up. In particular, and I'll show you a chart here in a minute, long-term employment is getting out of hand. A lot of people who have been unemployed for 6 months or longer, especially young people. If I'm in my 20s right now and I got a college degree or I went and did anything other than a skilled trade or nursing, I'm having a hard time and I'm probably pissed off. That's going to matter when the next elections come. Who they blame probably is the swing vote. I actually think that these numbers are all right around 9 trillion or 10 trillion. And then you have the deficit spending on top of it. What's interesting is that most of this debt is at lower interest rates than current interest rates. Now, by 2027, rates won't be at 4%. They'll probably be 3%. So some of the debt will be replaced on par. Same thing in 2028. When you're looking at over $5 trillion a year of not having the money, where's it going to come from? Just so you understand where this debt is coming from, in 2026, a lot of it is the 5-year notes that were issued during COVID. Now, there was an argument back at the time that they should have termed out the debt further. I agree with that. President Trump said that. Because if the Fed was the one buying the debt, why didn't we just make it 20-year bonds or 50-year bonds? I actually agree with that. I believe, and this is par for the course, I think that the politicians like to have crisis and bailouts. I think that they know that's how they keep their jobs. I think that's how they know, that's where they get their money from. If everything ran smoothly, it'd be a lot harder to steal. I might be getting to be a grumpy old man, 55 years old, but I think the 4 out of 5 politicians are dog shit. And it doesn't matter which party. Some of them just stink different. And the willingness of so many politicians to throw so many people under the bus so often and then point their finger the other way, I don't know. I'm over it. I think you should be too. Well, I definitely think that one party has been more crooked than the other. One has been quite ineffective, given a couple of really good opportunities to be effective. I'm hoping the next time Democrats get a chance, they do it right. In 2027, you have a lot of the 7-year notes from 2020 coming due. So a lot of the debt in the next couple of years is in fact COVID debt. Average interest rate jumps. Interest costs, almost $1 trillion a year. Will soon be over $1 trillion a year. The share of the budget that goes to discretionary spending isn't very big. So Doge and cutting SNAP benefits and things like that drops in the bucket. Interest costs are projected to hit over 3% of GDP next year. What's a good GDP number? About 3%. So this means that all economic growth next year is on schedule to go straight to interest payments. Think about when you've been in debt in your life. This is like making the minimum payment. It takes eternity to get out of debt, paying the minimum payment, and that's what we're setting up to do. It's what we're doing. It's what we're doing this year. What ends up happening is crowding out. As interest eats up more and more tax revenue, there's less room in everybody's budgets for more spending. In the government, that means that discretionary spending goes down, which is what they talk about. Infrastructure spending goes down, which is not what they want to do. Well, the Republicans tend to be okay with that. Trump doesn't like that idea, but he hasn't done anything about it. And defense, are we really ever going to cut defense? We haven't cut defense, I don't think, in anybody's lifetime here. So there's just less money to go around. That's bad for the economy. Crowding out hasn't happened here since the financial crisis, and it only lasted about a year. So the Not So Fiscally Responsible Act of 2023 and that's actually wrong, and the debt limit adjustments in 2025 actually add to the deficit. Isn't that funny? Is in 2023 and in 2025, right? 2023 is when the two sides couldn't get together, so nothing got done and it got worse. Then in 2025, they went out of their way to make it worse. So the deficits are going up even as they complain about deficits. They do nothing about it. It's my point is that they have no intention of doing anything about it. And if they do for a little while, it's mostly about getting asset prices down so they can buy on the cheap. When I say they, I mean the connected, certain one percenters are in on it. Other people who want to be one percenters are in on it. I'm trying to let you in on it. I'm fairly certain that the correction that's coming, at best, is a 20 to 30% bear market, at best. I hope that's as bad as it gets, because anything worse would substantially damage the investing psychology of two generations. That could have a knock-on effect for the rest of my grandkids' lives, which would really piss me off. So again, I tell the story of when I was in Vegas this year. Somebody asked me why I'm still working. He goes, Kirk, I know about what you're worth. I said, yeah. He goes, why do you keep working? Because I don't know what's going to happen for my grandkids. I don't know. So I have taken it upon myself to make as much money as possible. And I have run a personal portfolio of 5 or 6 stocks at a time and Bitcoin from time to time. As a registered guy, I have to be more diversified, but I just had my audit, regular thing every few years, and it went great. So I'm telling clients now, hey, if you want to change things, as long as we have it in writing, we can do it. You want to be super concentrated, you want to be heavy in cash for a while, you want to flip this market like I'm going to talk about, we will try to flip this market. And by flipping the market, I mean getting heavy in cash, waiting for a correction, then buying it in force, for effect, firing with effect when the time comes. And that doesn't mean we have to predict exactly when. We just have to be patient enough to wait for when. Although I do think it starts in 2026. So the deficit projections are just disgusting. The tariffs are in the hundreds of millions of dollars, not enough to affect anything. The idea that he's going to send people checks for $2,000 or something, man, it's the dumbest, dumbass bribe idea I've ever heard. But it'll convince some people, oh, look, he sent me money. It's got his name on the check. I said something on X today. But the more research that I do on this, and the more people I hear on social media and around the world, and in bars and wherever else, on TV, saying dumb zuck things and being dumb zuckers, I've gotten to the point where I'm just calling them dumb zucks. And I don't like it. I want to be nice. And dumb zuckers don't usually know they're dumb zuckers. But they're dumb zuckers, and I can't help but tell them sometimes that they're dumb zuckers if they really needle me enough. And then I explain to them why they're so stupid, and then I block them. I don't know how the psychology of this all works out. I don't know if people are smart enough to do the math. There's so much ingrained gambling in the system right now that if you think about it in terms of gamblers, how often do they learn their lesson? Don't they normally just blame somebody else? Then after a while of saving some money, go back to gambling? I hope that's not what happens. I hope that they have some foresight. I hope they have some understanding. I hope they can get off ideology and the chant, the narratives, the narrative chant that's always out there, the noise that is amplified 100-fold with social media and the internet. I mean, it went up many times with the internet, and social media, I think, might be the worst psychological thing that ever happened to society. Freedom of speech, bullshit. The algorithms turn it into propaganda, not freedom of speech. You want freedom of speech, get rid of the algorithms. They don't have rights, or do they? So this is the budget. This is what they talk about. Non-defense discretionary spending. It's 14%. Sure, you can cut it, knock 3 percentage points off there. That'll pay the debt. What happens to all those people who can't eat, don't have health care? Be careful walking down a dark street. Defense, right? And this is actually wrong. It's higher than that, pushing it to $1 trillion. Right? These are last year's numbers. So what are the market ramifications of all this debt coming due? Where do we find trillions and trillions of dollars? Oh, the international buyers will buy it. Get to that in a minute. No, they won't. What ends up happening is without intervention, you can't really get interest rates to go down. What President Trump has talked about is let's get interest rates super low at the Federal Reserve level and then just roll our debt every 90 days. That's what he said. That's what he said. People go, oh, yeah, that sounds like a great idea. Okay, so the debt never gets paid. Interest rates are super low. That stimulates risk spending to the extent that there's any money out there that the banks can lend out. And you get a bubble, which we're on the verge of anyway with the AI stuff. Malinvestment, M-A-L investment, malinvestment. That is what all this debt is starting to create again. It's very similar to 2007. Very similar. It's not focused in the housing market. It's focused in the actual federal budget. And there's a way to fix it. There's a right way to fix it. There's a wrong way to fix it. Virtually guarantee we do it the wrong way, but maybe I'll be pleasantly surprised and we'll do it the right way. So crowding out of private investment, inflationary pressure, when they finally do the bailouts, we have this foreign buyer risk. I want you to understand that Japan has been slowly reducing their U.S. holdings as a percentage of U.S. Treasury debt, and China's been an outright seller for 11 or 12 years now. The rest of the foreign ownership of U.S. debt has basically been flat for about 5 years. The percentage actually has dropped. The absolute amount has stayed about the same. I have that here somewhere. So foreigners owned roughly 34% of all U.S. debt in 2014, and they're down to the low 20s now. That isn't a function of them investing less. It's a function of us asking for more and not getting it because they don't have it. And now they're pissed off too. So what happens? What happens when the combination of them having their own fiscal constraints and not a lot of political reasons to support us going into the midterms meet us asking for more? Maybe Saudi Arabia gives us $5 trillion. Let's say they do. What do we owe them? Maybe that's why they're getting rid of mileage requirements on cars. Maybe that's why they're killing clean energy investments. Clean energy, by the way, was the number one new employer over the last 4 years, and they're getting rid of it as best they can. The survivors will come out screaming. That's why we've picked out one of the survivors. We know who one of the survivors will be. They're already consolidating an industry in clean energy. But wait, there's more debt than just the U.S. Treasury. There's about $1.5 trillion of commercial real estate coming due in 2026. A lot of these loans were issued pre-COVID and then into COVID. 3.5% or lower interest rate. If you try to refinance a building right now, you're paying 7% or more. I know. I've tried to do it. I've tried to get $20 or $30 million. And they say you can have $20 or $30 million against your building. Yeah, but you're not getting it at 5, which is what you need to get limited partners generally, because otherwise you can't offer them a high enough internal rate of return. So you have all kinds of projects that aren't getting done because nobody can afford to buy the buildings because the prices haven't been marked down because the banks don't want to mark the price down because then it shows up on their balance sheet and they don't want to give you a loan at an interest rate that allows you to buy the building. Do you get the circular nature of that? The banks have these underwater buildings on their balance sheet. They don't mark them down because it makes them nick their balance sheet and their public perception. Their stocks probably crash to the extent that they're publicly traded, which most of the regionals are. At the same time, they won't loan you the money at 5%, which is what you need as an investor to go out and get limited partners and offer them a teen rate of return. So the regional banks screwed up the system pre-COVID, during COVID, and now. They have managed this so badly that when they start going out of business and they start going under, like SVB and Sovereign and First Republic, don't feel sorry for them. And when the executives get thrown in jail, which they won't, but they should, don't feel sorry for them. And when they get their bonuses clawed back and they get penalized, don't feel sorry for them. They asked for it. They leached off the system for years, and now it's coming to a head. I don't want this to be as bad as the financial crisis, but there's a possibility, especially if this administration doesn't act fast when the first cockroaches start getting crunched underneath vigilante boots. Here's what I've told you over and over again is the warning sign. When unemployment goes up. Unemployment and layoffs just started to go up. They're blaming it on AI. That's bullshit. It's because they can't make more money. And to satisfy shareholders and have margins go up, you got to cut headcount. And they're doing it at the end of the year right now. I don't know what happens in the first quarter, but if unemployment keeps ticking up, we got a problem. Because right now, your 20-somethings have been unemployed pretty long term. A lot of people who are switching jobs have been unemployed a long time. If these numbers all start moving out with more people unemployed long term, what does that mean for healthcare? What does that mean for Social Security contributions? What does that mean for money in 401ks that normally props up the stock market? It's not going to be there. What happens, anywhere between 3 and 6 months, people haven't been getting paid. Their unemployment's about to run out if it doesn't get extended. What do they cash in? They cash in their 401k, pay the bills. They take that stupid tax penalty. So the idea that you can't predict this stuff is bullshit. It was bullshit the last couple of times. It's bullshit now. You can't predict this. The only thing that saves us right now is a fiscal and monetary miracle from people who are more likely to break it than fix it. And I'm not just saying the Republicans. The Democrats had 3 chances to fix things, and they haven't done it, right? In this century, they've had 3 chances where they had the presidency and the House and the Senate for 2 years, and they never fixed it. There's so many things broken with government that both sides have allowed to happen. We have never had so much debt due at one time ever. Not anywhere close. We're more than $15 trillion behind over the next 3 years. That means it has to be as big of a bailout as COVID, probably bigger. Or we just get back on the minimum payment plan again. And then we get another crisis. So what if the bailouts don't get QE right away? You get regulatory forbearance, extend and pretend. That's what's happening in commercial real estate right now. The SLR that we know that they already loosened up gets loosened up again. That means the banks are basically told, make loans, don't hold collateral, throw it all on red. And then the Treasury comes in and says, hey, we can't give you money, but we'll just guarantee we'll backstop stuff. The problem with that is that the unhealthy banks stay unhealthy. They don't lend. They eventually go under, cockroached out. And then other regional banks take their place. So there's a bank that I have targeted, and there's actually several that are on my list now. One in particular that is very good at taking over distressed banks. And they could grow very fast if this credit crisis happens because they're well-financed, well-connected, and they have set up a structure specifically to do this. Put a flag on that mountain. The result without quantitative easing is that you get a zombie economy, right? We just limp along for a long time. There are people out there calling for a mega recession or depression to correct things. How do you feel about that? There are better ways to do it, but people get brainwashed into thinking, we got to have some pain. Yeah, we're going to have some pain, but we don't need a depression to fix things. There is a very simple way to fix things. I alluded to it earlier, and I will mention it again in a second. Eventually, trying to avoid inflation leads to deflation and possibly a depression. I think the most likely scenario is a double dip recession, not a depression, but we shouldn't have to think about this. PE ratios in the large caps would contract to way below the normal 15 times. Right now, they're at 22, 23. So if they go down to PEs of 10 or 12, which is typical in a bear market, that's bad. That means the stock market loses half. Large caps lose half. It's a big deal, especially for people in S&P 500 index funds. Now, when they say, I'll just wait it out. Well, what if you're waiting 5 years to get back to even, or 6 years, or 7 years, or 13 years like after the dot-com crash? It's a long time. We come with shelf lives. All right, so what happens if there is QE? We know what happens. It's COVID all over again. You get the giant V-shaped recovery. Everything comes screaming out. But you have people saying they don't want to do QE. Unless they're forced to, they're not going to do it. Now, the politicians in Congress might force the issue. If they can get a veto-proof bill through, Trump can veto it. Congress says, screw you, we pass it anyway. It takes a lot of votes. Was it 67 in the Senate? Or is it 60? No, I think it's 67. Things got to be pretty bad for that many Republicans and Democrats to dance together. Now, there is a way to fix things. You can do both of those things, and it works. The math actually works. The reason I pointed out that the U.S. national debt and Social Security are about the same, like the deficit in Social Security through the end of the century is $40 trillion. That's what it is. The U.S. national debt, almost $40 trillion. If they print $40 trillion and buy out the entire debt, stick those bonds, instead of on the Fed balance sheet, stick those bonds into a Social Security lockbox. And you do 20, 30, 40, 50, maybe even some 100-year bonds. And because you're borrowing from yourself, you borrow at between 2 and 3%. And that's the only money that falls to the Treasury to repay over time. But instead of all that money going into the economy at one time, which caused that inflation that we got, largely caused the inflation of that and the broken supply chains, which we have again, the money would trickle in over a very long period of time, rather than whooshing all in a couple of years. So if you spread it out over 50 plus years versus in 2, that's a couple tenths of percent on inflation versus 10% inflation. It's doable. It's mechanical. It's in textbooks. It's not something I invented. Some guy named Gore. Some guy named Al Gore back in 2000 uttered the word lockbox. This is not a new solution. We can term out the debt for eternity. We can fortify Social Security, which is only underfunded because at some point, if you make enough money, if you made over $170,000 a year, you don't pay Social Security tax anymore. Right? They just get rid of that cap, and Social Security is fixed that way too. But I apologize for talking about maybe people who make 7 figures should pay a little bit more in taxes. I know, faux pas, not a good thing, because they won't create jobs. Oh, wait, they're laying people off. So here's the investor's dilemma. You have the conversions of the first part of the Treasury wall. If the government chooses scenario A, cash is king, asset prices collapse. Probably get a double-dip recession, maybe a depression. If the government chooses scenario B, it's what happened after COVID. In 5, 6, 7 years, we're here again. Option C is what I said, which they won't do because they're chicken shit, and it's too hard to steal when you have a real plan. So what probably happens is they try scenario A, they let asset prices crash, opportunistic people who maybe are in the know buy on the cheap, and then they do scenario B. Now, I've lost a couple of people on the call because I'm probably too political. I'm not too political. If you think I'm too political, you're too political. I care about following the money. I've been doing this since I was a teenager, probably younger than that, because I got yelled at by old men who made me go get their race forms at the corner store. In return, I got some money for candy. The level of bullshit out there right now is off the charts. The trader narratives that are out there are off the charts. The fact that the government is overtly lying to us over and over and over again, not even, your typical political lies. I mean, saying things like trillions of dollars in tariffs so we can get rid of income taxes. Come on. Anybody who thinks that's remotely true is easily convinced of dumb stuff, as about as diplomatic as I can make that. So the plan is very simple. I am scaling to a 60% cash position by the 3rd week in January. I will reassess then to see how close we are to things falling off a cliff. I'm not going to say sell almost everything, even though I'm kind of gradually doing it, until we see the moving averages roll over. When the 20-day moving average gets broken to the downside, that's probably it. The 50-day moving average is when people start bailing left and right, and we head all the way to the 200-day moving average. We typically use the weekly charts because normally we're in an uptrend and we don't have to worry about the long-term downtrend. We're using the monthly charts now. Teresa, are you ready? How are you doing tonight, Teresa?
I am doing very well. Thank you.
So we are going to look at your S&P 500 chart first because it's the broader
Alrighty.
index, the one that people live in. And can you talk about monthly demand zones?
Yes, very long-term chart. Monthly demand zone represent where monthly buyers stepped in, which of course is a much larger, more forceful group than weekly buyers. We see that broadening pattern that you've been talking about for a while, that megaphone that's drawn with those orange lines on the chart. As you pointed out, we have not seen the price has not rolled over yet. It's still climbing. And very correctly, in my opinion, you said we need to see that roll over. And I would totally agree with that. So, what that chart supports is price climbing up maybe to 725, 750 at any rate, up at the top of that pattern. And then if when we get that very bad economic scenario, then price starts down. And that's I drew two scenarios on there. The kind of a worst case where we lose almost half of the value, and then the other scenario we just go back down to where we were in April of this year.
Right. One of the things I've talked about is a gigantic head and shoulders forming. So if this is a shoulder and this is the head, then yeah, we'd come down to here and then we get another one before the double dip. The thing that I'm concerned about is if they don't put any supports in, I think it's pretty easy to see it come down to here, which is only the 2022 lows. I mean, that's not even the 2020 lows. So the 2020 lows where they put the brakes on things collapsing, right? This is all the new money from then pushing it up. A 50% or 68% retracement, depending on your Fibonacci preference, says here.
That is true. It could definitely get worse. The thing is then as you said, when will they step in? Because what happens is a downtrend begins. And at that point, that just means that any zone, any Fibonacci, anything you're going to come up with is going to keep getting violated to the downside until they decide to not do that any longer.
Right. Yeah. So with QQQ, that has a lot of the highly valued stocks. And again, another megaphone pattern, right? We've talked about the megaphone pattern setup that is rare, but it's happening. Typically, you break down to the bottom of the megaphone or through it. Unusual that you don't, actually, in history. I think it's 6 out of 7, they break through the bottom of the megaphone. So this is QQQ, your highly valued stocks.
QQQ, in a sense, was sort of even easier to me to see the pattern. S&P was fuzzier. I thought QQQ was pretty crystal clear. Again, we have to break down first, but I think that it looked to be like QQQ is closer to finding a top, although it has to break down first. But then those blue and then the orange dotted lines in there, I thought were fairly easy to see.
Yeah. So here's my question. And this will tell me how clear I was. I'm going to ask the head of the class here a question. Are you ready?
I'm ready, but I don't know about the head of the classroom, but go ahead.
So what makes stocks turn down in the face of people not wanting them to turn down? What has to happen? What does there have to be less of?
Well, money, liquidity. You have to, for some reason, need to cash out.
Right. And that's what the credit crisis creates, less liquidity.
Yeah.
So the time frame for that playing out, I think is second quarter and later. I think the first quarter is probably okay. I think that's the exit strategy, right? Because we have a potential for a Santa Claus rally. Maybe today it started. We have the likelihood of the January effect, at least through the option expiration or to about the option expiration. But liquidity is drying up. And Shooter's going to talk about where liquidity is drying up. So Shooter, if you're ready, why don't we bring you on and you can talk to us about the yen carry trade. Now, we have been talking about this actually since spring, the first time it started to break down, and then it didn't break down. All right, Scott, are you ready to accept being a panelist?
You got me?
I do. Wonderful heat map behind you. Talk to us about the importance uh, of of the yen carry trade. Just explain to people what it is and why it's breaking down and what that could lead to.
Okay, so first of all, we want to understand the micro drivers, macro drivers, and what really funds equities or stocks. And usually before we look at stocks, or at least me, when I look every week, I want to see where the liquidity is. Is China printing money? Is the yen carry trade still in play? And it's kind of like the throttle, when sometimes people sort of push it down, we accelerate. And you'll notice how the NASDAQ has accelerated. Now, I'm not looking at price on the NASDAQ itself or the price in the SPY. I'm looking at the driver, that accelerator that drove this inflationary push that we saw. And the reason being is that people borrow money, large corporations borrow money in the yen, and then they invest in equities. And just like when China prints money, nobody trusts the Chinese market in China. So that's a driver for our economy as well. And we have a crossroads in front of us when we look at the US JPY pair. And the estimate is about a 10% decline for every tick that we see below 150. Well, this week we pushed down to 155. Now, the lowest point we've been on the chart for the last couple of years. And if you're actually looking at that weekly chart, you'll notice how we track the financial crisis. We go back to the 2022 high in equities. Notice how the yen rallied after we were already in a drawdown. Now, note that if we look at July of 25, we started our drawdown then, and we got all this noise between the NASDAQ and the SPY at the same time. So you hear me a lot talk about peaking drives and how that liquidity comes in and drives these markets. And I think it's a combination of all of the above, but I think there's a great risk right now that the yen carry trade dries up. Now, one thing I've not been successful in clearly identifying is how big is that in relationship to all the capital that's invested in the US market. Some estimates are 15 trillion. Some estimates are as low as 5 trillion. So we're looking at 5 to 20%. And, then we bring in the derivatives to that, which are also being leveraged to create liquidity across the board. Now we have crypto into that game. And something we saw in November or early November the 10th was the drawdown that happened in the Bitcoin market and crypto market that was the tell, or it led the following decline that we saw in equities. Those are all signs of the liquidity drivers drying up in this market. And I think it's very important that we want to recognize that. We can basically look at the yen as it ticks lower as a percentage of the NASDAQ or a percentage of the SPY. You note the percentages that are on the chart that I'm looking at here. So the SPX is up 250% versus the yen is only up, or the US dollar JPY is up about 36% at this current point. You push up to the NASDAQ, it's up like 450%. So we're talking 7 to 10x. The indexes are overvalued versus the US dollar JPY. So the question is, how fast can it unravel? And I think Kirk's right. I think there's a very strong possibility that we unravel. However, I don't know that we see a 50% drawdown. You hear all kinds of noise out there, but it definitely is a red flag. And as we continue to decline this week, I'm now looking at it 4 or 5 times a day now. I want to see the volume come in on the short puts. I want to see the derivatives of what number. I have about 6 different instruments that I'm following on that, because I think it's important. Now, the advantage here is I think I can see it. That is, if I'm watching it. So in this scenario, I think I have a very good beat on it. And, ultimately what I am is a price trader. So whether we're in a bullish market or a bearish market. In fact, I'm actually a better short trader than I am long. So if we look at the comparison between the indexes, the only thing that we see flat right now, which I think is an outlier event, is TLT. Why hasn't TLT responded equally to the NASDAQ or the US dollar JPY? And there's only one logical conclusion, is that it's being manipulated so it doesn't scare the markets. And that's the point that I was trying to get across. I think the market is totally rigged here. I think they have a roadmap. I think they know exactly what they want to do, and I think they know exactly what their target is. The problem is that we're the bait that's going to provide the liquidity for these folks to get out of these markets, and we're going to be left holding the bag, just like we have been with every other crisis. That's my 2 cents, buddy.
So you heard what he said. He's a center right guy. You heard what I said. I'm a center left guy. We're both saying pretty similar things, right?
Correct.
So now Shooter is starting his own service. And if you want day-to-day and week-to-week trades, I think you should subscribe. I can't have that for regulatory reasons because it's not what I do. And I had my audit, and that's the one thing that they pointed out is, hey, keep everything consistent. Now, Shooter's got a unique subscriptions structure where the more people sign up, the subscription rate goes down, which is pretty clever. So if you have found him of value trading with him, or you just like the analysis in the shorter term time frames, I think you should go and subscribe. It'll be worth a couple $1,000 a year, and then it goes down as you make more money and more people join. For short-term traders and people who just, over the next year, or actually over the next 3 years, if things are as choppy as I think they're going to be, you're going to want him on your side.
It's going to be choppy.
Yeah.
It's going to broaden. We're going to, the great thing that, I've spent a lot of time on in the last 10 years is really avoiding what I went through in the Great Recession. And, I've spent a lot of time understanding both sides of the roadmap. And, I have a mixed bag here at Swing Trade Notes at Substack. I have a free version, which allows people to come in and see pieces. And then it also has premium services that I'm offering to the members that support the group. And ultimately, what I'm trying to do is build a box where I have the higher price data coming in quicker, because most people don't realize, at least on the retail side, how expensive that really is. You can drop 50 grand pretty quick on different solutions to really see the big picture. And as this market changes, we want a better gauge of what's going on. I want a better gauge of what's going on. So ultimately, my intent here really is just to fund my mission of being better connected to this market. Really, I'm being real selfish in why I'm doing it, because I want to make sure I'm connected to the market so I can see the move or predict the move before it happens. And ultimately, that's my purpose. All
right, Teresa, are you back?
Yes, I am back.
All right, so we're just going to say goodbye really quick. I don't know how to. There you go. There's the 3 heads. I don't know if they'll all show up on the screen. Everybody, awesome. I don't intend to scare the hell out of you. You know that I don't do it often. This is the 4th time in my career where I've said something really bad is coming. We can't time it perfectly. However, we know what to watch for. And if credit tightens up, that means liquidity will fall. And if liquidity falls, everything falls. And then the question is, how do they bail it out? I agree with Shooter. I think the public is the bag holders. Don't be a bag holder. And, sometimes I'm slow to get in, and usually I'm early. I think everybody has come to understand that I am seeing things 2 and 3 years out pretty regularly. I've only hinted at this for a year now, year and a half. And I've never been a debt bear. Never. I've never been one of those guys who said, hey, the debt market's going to crush America. But we've gotten to a point where they made the choice to condense all the debt into a 3-year period. Something's going to happen. And it will only get fixed by a combination of things. And I don't think it'll get fixed the first time. I'd be pleasantly surprised if it was. Ultimately, there will be more inflation. But before there's an inflationary fix, there will be a deflationary crash. And what we should all hope for is that the small businesses don't get destroyed. We need the small businesses to survive. So my plea to everybody is, if you're spending money on Christmas or you go out to eat, buy local, buy small, keep somebody in business. I have cut my Amazon shopping by 90% over the last couple of years. I am going to cafes. I don't go to any of the big chains ever anymore. I lied. I went to Arby's a couple of weeks ago because I was dying. And salty meat.
Arby's, huh?
Yeah, and salty Arby's, salty meat. We got the meat. So
that's meat?
Yeah. So yeah, is it meat? Recessions are normal, corrections are normal, and people get bent out of shape from it. Have an emotionally secure way of dealing with it. Have a plan, measure your risk, and I would say take your tax losses earlier in the year than later, and take your tax gains at the end of the year when you see what you need to balance with. I think most people do their tax loss selling backwards. So if you have gains and losses, you're not sure what to do with them this month, maybe you do put it into January. Everybody has their own balancing to do. And remember, your small catalyst-driven companies that are going to get through financially, you don't get rid of those if they're cheap. It's the stocks in the middle of the market. It's the stocks with very high valuations. And it's the stocks where you look at a chart and the volume is falling. If volume is falling, but price hasn't fallen yet, price is going to follow. That's your negative divergence. So look where volume is falling, which is the whole market right now. And that has given you the signal that prices probably start to fall. It's usually within about 2 months, but it could be 4 or 6. Hard to know. We don't know how much money from the Treasury General Account is going to find its way into the market. We don't know how they're going to goose the overnight repo market, but we know that those things are like the last things that happen before an emergency, and they're starting to happen. We've already seen the Fed bail out the repo market a couple of times overnight, taking back subprime collateral, MBS. So if the Federal Reserve is finding it necessary to not take pristine capital, which is normally what they get, they usually get U.S. Treasuries as overnight collateral. If they're taking mortgage-backed debt, those are the cockroaches, folks. All right, avoid cockroaches, be real careful, and think about how much risk you want to take. Be very, very slow to get out of the market. Watch the moving averages. As we start to break the 20-day moving average, I think that's the big warning sign. Shooter, how many things have actually broken the 20-day moving average so far? It's not many yet, is it?
No, it's not a big number. Yeah. I mean, the biggest thing is the advancing and declining line that we're seeing. It's kind of flat, but we're still having a decent number of new stocks at all-time highs. That's something I look at weekly. So I think the strategy is, and I'm just going to talk about EMAs if I may for a second, is, I use a 3, 5, 8, 14, 21, and 55 EMA, those timelines, because I find they closely match what Elliott Wave actually does. So when, like my confirming trend support line, once that breaks, then I flip to the EMAs and I have a percentage to be taken out once those SMA averages or those EMA lines are crossed. So you have a structural way of exiting the market as we're declining. I think that's a very strategic way to look at it, and that's what I'm going to suggest that everybody does, is just build a model around those EMAs on how to scale out and trim into new highs. You want to take, obviously revenues off as we continue to climb. Basically, you're selling into any rally at this point. That's my 2 cents.
All right. Everybody have a great rest of the night. I will have this up on YouTube by Saturday morning, maybe by Friday. And
enjoy Vegas.
Yeah, I will try to. Hey, I'm hanging out with my parents. How can it go wrong? So
Hey.
I'm teasing.
Take some pictures of that ghost town. I hear it's rough.
Hey, you know what? Okay, first of all, let's say goodbye and then we'll talk. Goodbye. But
Goodbye.
so Vegas, I actually had to pay for my room.
Yeah.
Wow.
It can't be that slow unless Caesars is just jobbing me. So we'll see. We'll see. I didn't get as good of a deal as I normally get, and I was kind of confused about it. So I don't know if they're really super slow. If there's a convention, I don't know what happened. My airfare was dirt cheap, but yeah, I actually had to pay for a hotel room. It just feels dirty. So yeah, we'll see. We'll see. If Vegas is dead, I will report back. All right, everybody, take it easy. Have a good one.
Have a great night. Thanks for having me.
All right. Good night, everybody.